Thank you for recognizing in your opening statement the importance of immigrants in keeping costs down. And I want to thank you and the administration for what has been an excellent 2023 economic report. We've got 3.1% economic growth, by far the best in the developed world. Headline inflation, 2.4%. And that's not a little blip, a 1 month number. That's for the whole of 2023 and compares very favorably with the pre-pandemic portion of the Trump administration when we had inflation of 3.5%. My goal here is to convince you to cut more and sooner because for a number of reasons. The first is that I know, if you ask a constituent, they want zero inflation and zero unemployment. You know that we can't have that and have concluded that the economy works best with a 2% inflation rate target. But I've looked at the history of that 2% number. It seems to come from Auckland from the 1980s. And there's a lot of arguments that your target should be just a little bit higher. Larry Summers recently produced a study arguing that the cost of money is part of the cost of living. So we have this weird paradox where you're trying to keep the cost of groceries down by raising interest rates, but as the ranking member points out, the big issue is housing. And your measure of inflation seems to treat all Americans as renters, even though 2/3 are homeowners. And so when interest rates go up, that's an increase in the cost of living for anyone with an adjustable rate mortgage, anybody looking to buy a house, anybody with a home equity loan. Obviously, we would cut interest rates a little sooner and a little more if your target was something closer to 2.3%. So I'll ask you, is there substantial economic analysis that argues that your target rate and the economy would work better if we had a slightly higher target than 2%?
Not really, no. What's happened is, you pointed out New Zealand, but what's happened is that 2% has become the global standard. And it's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation. We're at 2.4% right now, headline inflation.
I would ask leave to add to the transcript of this hearing numerous articles that argue for something between 2.3 and even 3%. I'm not arguing for as high as 3%. Let's look at Basel. There's nothing free here. If the standards are too high, we lose economic growth. If they're too low, we have bailouts and bankruptcies. But I think everybody agrees that the standard should be well crafted. You've got a system where everybody drafting this is well dressed and focused on Wall Street, and you've got Basel rules that discriminate against Main Street and for Wall Street. I'll give you some examples. 65 basis, it's 65% if you're a publicly traded company and make a loan to a publicly traded company. You make a loan to CalPERS, they're not publicly traded, without objection, like to put in their article into the record. And so they're, in effect, going to have a tougher time getting a loan. The local pizzeria is going to have a tougher time getting a loan. You've got, in Basel III, ignoring mortgage insurance, which obviously makes the loan more prudentially sound for the bank and is very necessary for first-time home buyers. And you've got a system where if you make investments in long-term bonds on Wall Street and you put them in the hold-to-maturity category, you don't have to recognize the losses and mark to market. So I hope you'll look at these in terms of the competition between Wayne Street and Wall Street for bank loans. Finally, we go to clean energy investment. Can I count on you to personally look at the paradox where Basel III treats clean energy tax credits much more harshly than low-income housing tax credits for no ascertainable reason?
Yes.
Thank you.